Good morning and welcome to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. And joining me at MarketSite is fan fave Phil Davis. He's the CEO of Phil's Stock World. And Phil, it's pretty amazing. I had you on, 3-4 weeks ago. We were talking about what if S&P 500 at 2,500, and here we are. What if S&P 500 at 2,600? Let's just start with the big chart.
Are you speechless? It's
very hard to
incredible.
make speechless, but let's put up what you guys have designed for us over at Phil's Stock World with the big charts, and let's run through a number of different dailies that we have up here. Let's just take a look at the S&P. Give us your thoughts on that.
Well, I mean, look, I said it was looking toppy at 2,500. It looks more toppy at 2,600, but you have to factor in the fact that now, since then, the change has been that they're talking about tax reform, and in theory, if you cut the taxes, then the S&P companies will make more money. They'll drop more to the bottom line because they don't have to pay those pesky taxes.
Right.
In reality, though, all corporate taxes collected last year were $340 billion. So if you think about cutting 20%, if you cut that from 35% to 20%, that'd be about 1/3 of it. So let's say they cut $100 billion of taxes. That's spread across all the companies that are out there.
Isn't that what Apple has in cash or something?
Yeah, and most
like
of the money is earned by Apple.
Right.
If you look at it.
And I also know the premise is, okay, if we cut taxes, that means corporations have the ability to create more jobs. Is there any historical data to support that?
Oh, no, it's complete nonsense. Right. I mean, you've got Kansas is a great example of a complete failure of a tax cut to do anything for the economy. It actually made it so much worse, and the state's a complete catastrophe now. It's been tried before. We've had tax cuts before. It never boosts the economy. We've had the repatriation of taxes. That never helps either. They just hoard the money, bring it back, buy their own stock. It might boost the stock price, but it doesn't do anything for the economy.
Right. Well, let's
so it depends what your goal is.
Let's take a look at the next one we have on the big charts, the Dow. The Dow and also the NYSE, because there's a big difference when you look at the Dow relative to a more complete index, if you will.
Well, if you look at the NYSE performance on the big chart, we have the little red lines and such, and the Dow's way over and the NYSE is way under. Now that, the Dow is a weird index because the Dow is it's only 30 components in the Dow. It's very easily affected by, first of all, they change the components all the time, which is really annoying. So they added Apple not too long ago. They added Travelers. So they add sometimes stocks that start outperforming, but they took out the ones that weren't performing, like Honeywell and who else went out of there? Did Alcoa go out? I think Alcoa was out or something. I don't know. Anyway, so they take out low performers, put in high performers. Apple especially though. So Apple going up 50 points on the Dow is responsible for it's times 8 points. So it's eight per dollar. So it's times $400 for Apple, $400 for Boeing's another one that's been up tremendously, added 400 points to the Dow. So you have two components of the Dow that added 1,000 points between them, or 1,600 points.
Right. So you also look at the NYSE just so you can get more.
Well, so the NYSE is nice and broad. It's got thousands of stocks. It's like the 200-day moving average. Instead of the 10-day moving average, the Dow it'll go up and down like crazy based on a couple of components. The NYSE is first of all, the NYSE includes the Dow components, but it also includes small caps, mid caps, everything.
Right. Well, another reason to look at the Nasdaq comp
like the Nasdaq Composite versus the Nasdaq 100, because now the Nasdaq 100 is 15 to 20% Apple. So right there, it's like you may as well just track Apple instead of the Nasdaq 100.
Right.
The Composite, though, of course, of 2,000 stocks, I think it is. And that's a lot more reliable.
Well, with the Nasdaq 100 too, because it takes out the financial stocks that are on the Nasdaq comp, but the stocks that have been moving the market, right? That's what's all part of the NDX. So I think it's good when you look at it for a specific type of portfolio as well. So and I think that's what's interesting when you look at the NDX versus the comp.
Yes.
And let's round it out with the Russell, because you're starting to see some of that small cap performance.
You are, but I think the main reason that you're seeing that is because the Russell is so small of an index compared to the Dow, the S&P, the Nasdaq. I don't know the exact number, but I would say it's basically 1/100th the size of the other the Russell stocks compared to all the other stocks are 1/100th the size.
Right.
So let's say the other ones are 100 trillion, then the Russell is 10 trillion, that kind of thing. But so that means that money flowing into the market can tend to disproportionately affect the Russell. Money flowing out of the market will disproportionately hurt the Russell. So it's just sort of like a leading indicator. We use the Russell as a leading indicator because of that, because it's more sensitive to money flow. And by the way, there's some incredible statistics. I mean, Vanguard and BlackRock both reported today, and Vanguard's got 4.6 trillion under management, and BlackRock's got 6 trillion under management. 7 trillion, sorry, 7
and it actually grew year over year by a significant amount of money.
And it's all ETFs.
Yeah.
And the ETFs are indiscriminate buyers of all stocks. And that's why you get the Russell acting crazy, because the Russell is it's like a tiny indicator. You know, so it's like having a little tiny hose that flips around and goes all over the place versus a great big pipe that doesn't really move but just takes more water.
Yeah.
But the little hose off the same line will go whoosh like that. That's what the Russell is.
All right, I got it. Well, let's talk about a trade before we wrap this up, and we'll go international with this one's interesting, the RSX, which is the Russian index.
Yeah, we were featuring that one today because we were looking at the performance of all the assets over the past decade. And by the way, it's interesting if you don't realize it, but you say tech is leading, but it's not actually. Consumer discretionary stocks are actually doing better than tech over the last 10 years. Over any period of time you want to look at it, consumer discretionary is ahead. Tech's been catching up, but it's been consumer discretionary has been the real big story. It's an interesting thing. But we liked Russia. We were looking at countries that were lagging in the rally. And the big laggers are Brazil, which we already played. So we like Brazil still, but we already played it, and we had it at a much cheaper price. You've got Italy, and Italy's got banking problems. England has banking problems, and of course the Brexit problems. China is scary because of their debts and their system and all that. And Japan also obviously very scary because of all the debt. So we ended up focusing on Russia, of the lagging countries, of the countries that have not really performed as well as the others. And Russia, oil is stabilizing. Their government is gaining prestige around the world as we're losing ours. They're stepping in to fill the void, for better or worse. But I mean, you have to look at it from what's the value of Russia? They are stepping up on the international stage as we're pulling back. They're making trade deals as we're pulling out. You would think they were like manipulating the whole thing to their advantage. But it's all going their way. So the bottom line is, though, that makes RSX a good deal. And the trade we set up for RSX was, I don't have it in front of me. Do you have?
I do not, but just give us a
broad.
broad.
We featured an RSX trade that I'm going to add to the Nasdaq portfolio. Because we're keeping a portfolio of stuff that we pick on the show.
Yeah.
And the gist of it was to take a bull call spread on RSX with 15 contracts. And I don't remember the number. I wish I did. But and then we were going to sell some puts against that also to mitigate the cost of the trade. I think the puts were 20. So I think the trade was something like a 22, 26 bull call spread, and then selling the $20 puts. I think that was the trade that we were looking for out to January 2019. It's a good trade. It's got a 300% potential return in 16 months.
All right.
So
well, we'll add
like
that link to the tweet so that everyone could take a look at it.
Yeah, we're gonna. We'll set up the portfolio so your
well.
people can look at it too.
All right. Well, sounds great. Thanks for joining me at MarketSite as always, and as always, traders, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
All right, thanks.